Hello, everyone. Let's start our today's discussion. Today, we will be discussing basic income tax calculation of individuals. It is a new chapter. I want you all to concentrate on it so that you can have a better idea. In this chapter, we will be discussing that how we have to make basic income tax return of individuals. With the help of this chapter, we will be able to proceed with other chapters of individuals, as basic income tax calculation will be referred in every chapter which we will discuss further. Now, first of all, when we talk about basic income tax calculation, you need to understand a basic format of income tax return. That how an income tax return looks like, what are the heads of the income, and what are the tax rates which are used. Patience and concentration will be very important since it is a start of new chapter. So at the beginning, you may face difficulty, but with passage of time, the things will get simple for you. Now, when we talk about an income tax return for individuals, the tax department in UK has divided incomes in three heads. The first head of income is non-saving income, the second one is saving, and the third one is dividend income. When we look at income tax return of individuals, it shows us three separate heads of income. In these three separate heads, all the incomes are divided and then the tax rates are applied on them. The first head of income is non-saving income, which include all the incomes except the interest income and the dividend income. It includes employment income, trading income, property income, non-saving income, saving income. Saving income includes interest income, and dividend income is the profit distribution from companies. Now, you people must be thinking that why these three heads of income are created. Why the tax department has divided the income in these three tax heads. Basically, the concept is that for every head of income, a separate rate of tax is used. Like for non-saving income, the rates of tax are different. For saving income, the rates of tax are different. And for dividend income, the rates of tax are different. For every head of income, there are different rates of taxes. Okay, I'll repeat it again. For individuals, when we talk about income tax return, which needs to be filed every year, the incomes are divided in three heads. The first head of income is non-saving, the second head of income is saving, and the third head of income is dividend income. Non-saving income includes all the incomes except the interest income and the dividend distribution. If the individual has received any dividend, it goes in head of dividend income. If he has received any interest, it goes in head of saving income. And all of the rest of the incomes are classified in head of non-saving income. Basically, non-saving refers to incomes which are not generated through savings. Employment, trading, these all are the businesses. These all are the economic activities. Okay, now the first head of income is non-saving, in which we have employment income, trading income, real estate investment trust. We will discuss this topic in a while. These are the mutual funds which invest in property market, property income, rental incomes, pension income if you have invested in a pension fund, trust income, then the interest income which goes in head of saving, and then the dividend income which goes in head of dividend. So when we talk about individuals, the income tax return has divided the incomes in three heads: non-saving, saving, and dividend. Non-saving includes all the incomes except interest and dividend. The interest goes in saving head and the dividend goes in dividend income head. Now the employment income, non-saving, trading income, non-saving, real estate investment trust, non-saving, We will discuss each of the incomes also in detail in further chapters. Currently, we are just looking at how a tax return looks like. Employment income, the income from job. Trading income is business income. Real estate investment trust is income from mutual funds which invest in property market. Property income, if you are earning from rental incomes directly. Pension income. Trust income, we will discuss that what are trust, when are they classified as non-saving, when are they classified as dividend. It will all be discussed in detail. Currently, we are just discussing that how a tax return looks like and how we have to calculate the tax. Interest income goes in the head of saving income and the dividend income goes in head of dividend. Once we have classified all the incomes, we arrive at the value of total income. Now, from this total income, personal allowance is available. Personal allowance means an amount of income which is exempted from tax. Now, this amount is 12,570, 12,570 pounds. Okay, now this is the total 12,570 pounds. We first deduct it from non-saving. Then if it is remaining, we deduct it from saving. And if it is still remaining, we can deduct the remaining amount from dividend income. We will then arrive at the value of the taxable income on which the tax rates will be applied. If we are a basic rate taxpayer, which means income from 1 till 37,700, the rate of tax is 20%. Then between 37,700 to 150,000, the rate of tax is 40%. We are currently talking about non-saving, and after 150,000, the rate of tax is 45%. The personal allowance is 12,570. We make tax return for the fiscal year, for the tax year. The tax year of the UK is from 6th April to 5th April. Currently, in this exam attempt, we will be studying the tax return of 6th April 2021 to 5th April 2022. As a round off, because it is very odd to remember 5 and 6 days. So the examiner says that instead of 6th April to 5th April, you can write 1st April to 31st March. So the tax return which we are studying in the current exam attempt is 1st April 2021 to 31st March 2022. Now, this course, this tax return, this exam course will be examinable in exam attempt of June 2022, September 2022, December 2022, and March 2023. You all must be thinking that why the tax year is 1 year behind. So always remember that tax return is filed after the end of the year. It is not filed during the year. I will repeat it again before moving towards practice questions. My approach is very simple, that first I give a concept and then we go through multiple practice questions so the concept gets clear. The most important thing while studying with me is patience, concentration, and trust on me that yes, the sir will make the concept clear. Don't rush, listen to me carefully. So in this chapter, what we are talking about, we are making the tax return for individuals. That how an income tax return, income, the amount earned by a person during a year will be taxed. It is about individuals, not about companies. That how an individual will pay income tax. So for income tax return purpose, the incomes are divided in 3 heads. The first head is non-saving income, the second head is saving income, and the last one is dividend income. Non-saving includes all the incomes except interest and dividend. Non-saving income includes all the incomes except saving and dividend. It includes employment income, trading income, property income, all the incomes except the interest and dividend, because the interest and dividend are classified in their separate heads. Now you must be thinking that why they are classified separately? Because the tax department has kept separate tax rates for them. The purpose of making these three income heads is to define separate tax rates. One set of tax rates is for non-saving, one is for saving, and the third one is dividend. Saving income refers to interest income, one is dividend income, the distribution received from companies, and the last one is non-saving, which we can call as a normal head. All the incomes except interest and dividend, employment income, trading income, real estate investment trust, we will discuss this concept, property income, the rentals, pension income, trust income, donor, trustee, beneficiary, we will discuss this concept. Interest income goes in head of saving, dividend goes in head of dividend. All incomes are added to arrive at the value of total income. Then we deduct the value of personal allowance, which is 12570, to arrive at the value of taxable income. Then the tax rates. If your income is between 1 to 37,700, the rate of tax is 20%. Between 37,700 to 150,000, the rate is 40%. And after that, the rate of tax is 45%. These rates of taxes will be given to you in the examination. So if someone forgets them, there is nothing to worry about. The personal allowance is 12570. And the tax year of UK is from 6th April to 5th April. In our current exam attempt, we are studying 6th April 2021 to 5th April 2022. As a round off, we say it as 1st April to 31st March. Okay? Now, let's look at one practice question so that you can have an idea that how the things will work around. Listen to me carefully so that you can have an idea. Mr. A has following incomes for the year. Employment income 30,000, trading income 20,000, property income 10,000. Now, all of these three incomes are non-saving incomes. All of these three incomes are non-saving incomes. The employment income is 30,000. The trading income is 20,000. The property income is 10,000. So if I add up all of the three incomes, this gives me total income of 30 plus 20 plus 10, 60,000. The personal allowance is an amount of income which is exempted from tax, 12570. Now this will give me a value of taxable income. Now, if you look at it carefully, it is simply a clerical approach. There is nothing difficult in it. All three of the incomes were non-saving incomes, employment, trading, and property. Then from total income, we deducted personal allowance. So this gave me taxable income of 47,430. Now we'll apply tax on it. Our non-saving income is 47,430. Till basic rate band of 37,700. till basic rate band of 37,700, the rate of tax is 20%. Now on the remaining income, if I look at the remaining income, because after 37,700, the rate of tax increases to 40%. On 9730, the rate of tax is 40%. So this gives me 3892. So my tax liability will be 11,432. So if you look at it carefully, I don't think that I did something difficult. As I told you, that when we talk about individual tax return, when we talk about a tax return of an individual, when we talk about tax return of a human being, an individual, the incomes are divided in three heads of income: non-saving, saving, and dividend. Now, non-saving includes all incomes except interest and dividend. Non-saving includes all incomes except interest and dividend. It is a normal head of income. Then there is saving, and then there is dividend. Now, you must be thinking that why the incomes are divided in three heads. What is the reason of doing this? Because the tax department wants to define separate tax rates for each head of income. The tax department wants to define separate tax rates for each head of income: non-saving, saving, and dividend. Employment income, trading income, real estate investment trust. Don't get worried about them. We will study each of the income in detail. Non-saving income, saving income, and dividend income. We arrive at the value of total income. The personal allowance is 12570. Then we arrive at the taxable income. The rates of tax: till 37,700, the rate of tax is 20%, as we did in this question. Then till 150,000, the rate of tax is 40%. The fiscal year, the tax year for which we are doing discussion, is that normally the fiscal year, the tax year is from 6th April to 5th April. Okay, but for simplicity, the examiner says that you can write it as 1st April to 31st March. We are studying tax for the fiscal year ended 31st March 2022. Okay, now, in this question, there was employment income, trading income, and property income. All three were non-saving: total income, personal allowance, taxable income. Till 37,700, the rate of tax is 20, and after that it increased to 40%. I hope that it is pretty much clear. There is nothing to worry about. See, my approach is very simple. That I teach a concept and then I do a practice question. Once we complete a chapter, we do some attempt-wise past papers so that you can get a clarity. Okay, let's look at one more practice question. Mr. A has following incomes. Employment income is 50,000, property income is 25,000, and trading income is 5,000. Again, all of the incomes are non-saving income. Employment income employment income is 50,000. Then we have property income. It is 25,000. And then we have trading income. It is 5,000. Okay? All of the incomes are non-saving. So what about saving and dividend? We will discuss them. Don't rush. Okay? We will add all of the incomes to arrive at the value of total income. Now 50 plus 25 plus 5. This gives me total income of 80,000. Personal allowance. The amount till which is exempted from tax, 12,570. The taxable income will be 80,000 minus 12,570. So this gives me 67,430. Now we'll apply tax on it. Non-saving income, 67,430. On starting 37,700, the rate of tax is 20%. So this gives me 7,540. Then Then 67430 minus 37,700. So it's 29,730. The rate of tax is 40%. 11,892. So the tax will be 19,432. So in my opinion, there is nothing difficult. You just put the income in the right head, you deduct the personal allowance, and then you apply the rate of tax. I think there is nothing to worry about. Is it clear? So, what we are doing is, we are making basic income tax return of individuals. What we are doing is, we are making basic income tax return of individuals, that how an income tax return of an individual looks like. So in case of individuals, the first head of income is non-saving income, which is a normal head of income. Then there is saving income, which is interest income. And the last one is dividend income. In non-saving income, we include all the incomes except the interest and the dividend. We put all the incomes, and currently I have told you that don't worry about these incomes like what is real estate investment trust, what is pension. We will discuss each and everything in detail. Currently, we are just making through the tax rates. Put the incomes in the right heads, deduct the personal allowance, and apply the tax rate. That's all. Till the basic rate band, the rate of tax is 20%. Then the rate increased to 40%. Now, these are the bands. It is not like on the whole income it will be 40%. These are bands. You have to look at the tax bands. Okay? So, in the practice question 1 and 2 both, all the incomes were non-saving. Personal allowance, taxable income. Till the basic rate band, the rate of tax is 20%. And then the remaining income is taxed at 40%. Is it clear? Anything you want to ask? Anything you want to ask? Any query? Okay. I hope that it's clear till here. Now what we are doing is we will explore the different terms. Like we will explore that what is real estate investment trust. We will explore the saving income. We will explore the dividend income. We will discuss the different things and we'll continue doing the practice questions and the things will get clear in your mind. Okay? Now let's discuss that what is a real estate investment trust. Now, when we talk about a real estate investment trust, it's a very simple concept that basically these are mutual funds. Now, what is a mutual fund? Mutual means many people are gathered in it. It is a many people fund. Now, what happens is that these real estate investment trusts raise funds from the people. It is a mutual fund. It raises fund from the people. It issues its shares. It issues its units. Like a real estate investment trust will come to you and they'll say, okay, give us the money and we are giving you the ownership in our fund. So everyone invest in these funds. Now what this fund will do is it will gather all the amount and it will invest in the property market, in the real estate market. It will earn rental income. It will earn capital gains. And then whatever it will earn, it will distribute it to its shareholders or to the unit holders in form of a dividend. The tax department says that we will not treat this amount as a dividend. Rather, we will treat it as a non-saving income. We will treat it like a property income because it is earned from real estate market. It is not earned like an income of a company. It is earned from real estate market. Listen to me carefully. What is a real estate investment trust? It is a mutual fund which raises funds from the public and then invests those funds in real estate, the property. The source of income of REIT is capital gains and rentals from the real estate market. Amount earned by REIT is distributed to unit holders, the owners, as a dividend. From tax perspective, dividend from REIT is taxed as non-saving. It is taxed as a normal income. It is not taxed as a dividend income because the tax department says that it is earned from property market. So we will treat it like a property income. We will tax it under the head of non-saving. We will not tax it under the head of dividend. We will tax it under the head of non-saving because it is amount earned from the property market. Now, one new thing for you people, withholding tax. Now you must be thinking that what is withholding tax? Now you must be thinking that what is withholding tax? Basically, withholding tax means tax deducted at source. Now, whenever a real estate investment trust will distribute a dividend, the tax department will deduct 20% advance tax. Now, this advance tax will be adjustable in our final tax liability. We will discuss this issue in a practice question. Whenever a real estate investment trust will distribute a dividend, the tax department will deduct advance tax. The tax at source will deduct advance tax, the tax at source of 20%. This advance tax will be adjustable in our final tax liability. How we will work it through, we'll look in the practice question, so no need to worry. So what is a real estate investment trust? It is a mutual fund which raises funds from the public and then invests those funds in real estate market, in the property market. Basically, a real estate investment trust issues its shares, issues its units to the people, to the owners. They say, okay, we are issuing our shares, we are issuing our units. If you are interested, you can buy. They gather up a fund, they gather up a mutual fund, and then they invest that money in the real estate market. They invest that money in the property market, and they earn the rentals and they earn the capital gains. The amount they have earned, they distribute it to the unit holders in form of the dividend. Now, the tax department do not tax it under the head of dividend. They tax it under the head of non-saving because they say that it is earned from real estate market. It is earned from the property market. So we will treat it as a normal income. Normally, the dividends are taxed in the dividend income head, the dividend which we get from a company. But the dividend of a REIT is taxed as a normal income. The advanced tax is 20%. Okay? Let's look at a practice question. Let's look at a practice question so that you can have clarity. The key to success is practice. Okay? Don't rush. Listen to me carefully. The things will get clear with passage of time. Now, again, non-saving incomes. Trading income is 52,000. Pension income is 2,000. Trading income 52,000. Non-saving income. Pension income is 2,000. Non-saving income. REIT dividend. Always remember that if the examiner is silent, the income is net. The net means that withholding tax is already deducted. Whenever the examiner is silent, like see here, the examiner is silent, that whether it is net or gross. So we assume that it is net. Net means that withholding tax is already deducted. So we will gross it up. First, we will calculate the total tax. The withholding tax, the advanced tax is 20%. Since the examiner is silent, so we are assuming that it is net. So we will gross it up. The gross amount is 11250. I will repeat it again. I will repeat it again. On REIT, you studied that the withholding tax, the advanced tax is 20%. Now, since the examiner is silent, in the question, the examiner is silent that whether the amount is net or it is the gross, the full value. So we will assume that the amount is net. Net means already 20% is deducted. Net means that already 20% is deducted. So we will gross it up. The withholding tax of 20% is deducted. So we will gross it up. Divided by 80 into 100. Okay. Now, our total income is 52,000 plus 2,000, 54,000 plus 11250. So it will be 65250. Now we will deduct personal allowance from it. The personal allowance is 12570. This gives us the taxable income. Please listen to me. 12570. This gives me taxable income of 52680. Now we will apply tax on it. Non-saving income 52680 up till 37,700. The rate of tax is 20%. So 7540 on the remaining. On the remaining 14980, the rate of tax will be 40%, 5992. So this gives me tax liability. This gives me tax liability of 13532. Now, one new thing. See, there was some advanced tax which we grossed it up. The income was net. We grossed it up. There was some advanced tax of 20% which was already paid. So, how much was the advanced tax element which we grossed it up? So it was 2250 tax credit. So this gives us the tax payable, because since we paid some tax in advance, so that will be adjusted. So the payable will be 11282. I will repeat it again. I want you all to concentrate on it. See, there is nothing difficult in it. There were three incomes. We classified them. Real estate investment trust, 20% withholding. The examiner is silent, so the income is net. So we grossed it up. Divided by 80 into 100. Personal allowance, tax. So what is a real estate investment trust? It is a mutual fund which raises funds from the public. What is a real estate investment trust? It is a mutual fund which raises funds from the public and then it invests those funds in the real estate market. It earns rentals and it earns capital gains. It earns rentals and it earns capital gains from the real estate market. Whatever it earns, it distributes to its unit holders, to the shareholders. The tax department treats it as a non-saving income because the tax department says that this amount is earned from the real estate market. Withholding tax, the advanced tax is 20%. If the examiner is silent, the amount is net. So we grossed it up. We got the value of total income. We deducted personal allowance to arrive at the value of taxable income. On the taxable income, we applied tax On the initial 37,700, the rate of tax was 20%. On the remaining, it was 40%. The advanced tax was adjusted and we got the value of payable. I hope that you people are getting it. Okay? Let's look at one more practice question, because practice is the key to success. Mr. A has following incomes: trading income, pension income, REIT. All of the incomes are non-saving. So we made a head of non-saving income. Trading income. What is the value? 14,000. Then pension income. What is the value? 25,000. Then REIT. The examiner is silent. Withholding tax is 20%, and since examiner is silent, so it is net. We need to gross it up. Divided by 80%, multiplied by 100%. So the gross amount will be 13,750. Total income 14,000 plus 25,000 plus 13,750. So the total income is 52,750. Personal allowance, the amount of income which is exempted from tax, 12570. So the taxable income will be 40,180. Now you'll apply tax on it. The non-saving income is 40,180. On initial 37,700, the rate of tax is 20%, which I think gives 7,540, and the remaining, because after 37,700, the rate of tax increases to 40%. So 40%, this gives us 992,750. So the tax liability is 8,532. Now, what was the advance tax which was already paid? 11,000 to 13,750. So it's 2,750. This will give us a tax payable of how much? 5,782. So if you look at this practice question also, simply non-saving incomes, real estate investment trust, its net withholding tax is 20%. We grossed it up. Personal allowance, taxable income, tax banks. So I think it's pretty much clear there is nothing to worry about in it. Okay, So, if we'll do a quick review that what we have discussed till here, when we talk about individuals, when we are talking about a basic income tax return, so how it looks like. The tax department has divided the incomes in 3 heads. Non-saving, a normal head of income, saving income, interest, and the dividend. Non-saving is a normal head of income in which all the incomes are classified except interest and dividend, because their tax rates are different. Add up all the incomes, you arrive at the total income. Okay? Personal allowance, the amount of income which is exempted from tax, the taxable income, and then the tax banks. Up till 37,700, non-saving income is taxed at 20%, then this rate increases to 40%, and then it increases to 45%. The personal allowance is 12570, and then we looked at 2 questions. Then there is real estate investment trust, mutual funds, which raises funds from the public and then invest in the real estate market. They earn from rentals and from capital gains. When they earn, they distribute it in form of dividends. Okay? From the tax perspective, it is taxed as a normal income, not a dividend income, because it earns from real estate market. The tax department says that since property income is normal, so REIT will also be a normal income. The advanced tax is 20%. Now, how this advanced tax works? We gross up the income. We tax the grossed income, and the advanced tax paid is adjusted in the liability. I hope that it is pretty much clear. Okay? Is it clear? So I'll keep this session till here. I want you all to revise it. If you have any query, feel free to ask me. You all have my WhatsApp number. Okay? In the next meeting, we will move towards the dividend income. Then once done with dividend, we will move towards trust income. So this is how we keep on progressing. Okay? So for today, it's done. We'll continue in the next section. Thank you, everyone.